Your Excellencies, ladies and gentlemen, it's a great honour and pleasure to be here. I'd very much like to thank the organising committee of the 6th Doha Islamic Finance Conference for inviting me to participate in this prestigious event and to address the topic of scientific tools and methodology adopted in the predictability of financial and economic crises. The global financial crisis was clearly a wake-up call both for policymakers and the financial sector, and there's been no let-up in the uncertainty surrounding the global economy and financial markets since then. Just last year, for example, we had elevated concerns that the global economy was heading for recession, not least as a result of the US-China trade war. And even as those concerns have eased somewhat, we have the shock of the coronavirus outbreak, which is having a range of serious economic impacts, no longer simply confined to China, as well as heavy human costs. At the same time, we observe the continuing so-called Japanization of economies with slow growth, sustained below target inflation, very low or negative interest rates, and high levels of public and private sector debt. This is leading to extended levels of risk-taking by investors in the search for yield, resulting in stretched asset valuations and deteriorating credit quality. And while we haven't yet seen major market corrections in this cycle, yesterday's moves notwithstanding, there is need for increasing vigilance the longer the period of very low interest rates lasts. In this context, there is an urgent need for better tools to predict economic and financial crises. And it's my pleasure to be here to describe some of the work that Oxford Economics undertakes to support its clients in this regard. Just quickly by way of introduction, Oxford Economics was founded around 35 years ago as a joint venture with Oxford University's Business College. We've now grown to be one of the largest of the independent global macroeconomic forecasting consultancies. We have over 250 full-time economists on our staff based in all regions of the world. And we work with over 2,000 clients, including international institutions, governments and central banks, blue chip companies in all sectors, and many of the world's leading banks, asset managers, and insurance companies. In these remarks, I'm going to talk about three topics briefly. First, I'll talk about our approach to anticipating economic and financial crises. Second, I'll explain how we quantify the impacts of shocks that could trigger economic and financial crises using Oxford's well-known suite of global economic models. And then finally, we'll show you the results of the analysis we've been doing on the latest shock to hit the world economy, the coronavirus epidemic, before offering some conclusions. Let me begin by saying a little on how we look to predict turning points in the economic and financial cycle. Up front, we should be humble and recognize the limits of the ability of economists and the techniques that are available to us actually to be able to meet this task. All of the approaches that we have to use have their challenges, and we need to apply them in full appreciation of those imperfections. I think one implication of this is that a strong framework will actually encompass a number of different approaches. At Oxford Economics, we use three primarily. First, we've developed a range of nowcasts and real activity indicators that compile a large range of timely economic and financial data into a single measure for each economy. For example, with our real activity indicators, a principal components analysis is used on data sets that contain information on things like manufacturing output, production in highly cyclical sectors like cement or metals, electricity consumption, rail freight movements, car registrations, measures of trade and service sector performance, and so on. We also use a range of nowcasting models, using a variety of different techniques to help us understand how these developments relate back to the more established statistics like GDP that are published by national statistical authorities. Such real activity indicators and nowcasts can be helpful in providing an early warning of a significant change in trend in growth in an economy, which may be a sign of an impending crisis. They can also serve at other purposes too, for example, as a cross-check on the official data and its reliability. It's also worth noting that nowcasts and real activity indicators are one area where new techniques in machine learning can be very helpful. We've got a project underway at Oxford Economics that is using neural network techniques of machine learning rather than traditional nowcasting techniques that are applied by central banks. And it's also using a range of alternative qualitative data from web searches and elsewhere, in addition to more traditional economic style indicators. So it's still a work in progress, but our findings to date show that these new approaches are actually able to beat the standard nowcasts in out-of-sample forecasts by a significant margin. But machine learning is not a magic wand and needs careful application. For example, these techniques are typically able to get more out of carefully constructed data. They're not really able to sift through data and separate noise from insight without carefully defined bounds being put on them by analysts. The second approach that we use to forecasting turning points in economic and financial crises is monitoring signals from a range of leading indicators such as the yield curve slope, credit spreads, equity and commodity price movements, and so on. Now, to be honest, this is as much art as it is science, given that these signals are far from consistent in terms of their lead time versus the cycle in the economy, the proportion of false positives they give, and so on. They're also subject to structural shifts in behavior, for instance, as we've seen in the way in which the quantitative easing policies have changed the behavior of the yield curve. But as part of a suite of approaches to predicting crises, this kind of horizon scanning is certainly necessary. This leads on to the third approach we adopt, which is modeling the probability of recession. And again, there's a number of ways in which you can do this, and no one methodology is infallible. We tend to employ 3 methods and then average across them to give a more robust result overall. The first, I seem to jump one. The first of those methodologies, there we go. The first is to build probit models of recession, which are binary statistical models combining many of the lead indicators that I've just been speaking about. Applying this technique suggested that the risk of recession globally within the next 6 months reached as high as 30% last summer, but has since dropped back to around 15% and had settled there at least prior to the coronavirus. This is a technique that allows a very timely measure of probabilities to be derived, but on the other hand, the signals from these models change very quickly and in a somewhat volatile fashion with new data, and therefore it's advisable to take short-term movements in them with a bit of a degree of skepticism. The second methodology we adopt to model the probability of recession is to use past forecast errors to construct a fan chart around our baseline economic forecasts, which we then augment with the results of a proprietary survey we undertake of our clients, who, as I mentioned earlier, are a cross-section of government, central banks, blue-chip companies from all sectors. To explain a little bit more, at Oxford Economics, we've got around 20 years of monthly base case economic forecasts over a horizon of 5 to 10 years ahead. We measure the deviation of those forecasts against the actual GDP data so that we're able to collect information on the characteristics of the error distribution of forecasts at each point over the next 1 to 5 years and so on. Using that information, we're able to construct bands of uncertainty around each point in the forecast distribution, which is the same sort of methodology used by major central banks. A two-piece normal distribution is then used to incorporate skew into the distribution of those errors using the responses from our quarterly risk survey of around 200 or so clients. And this chart just illustrates the results from our latest client survey. This was conducted around the turn of the year. It suggested actually that clients perceived the significant downside risks to the economic outlook could become less serious compared to what they had been fearing last autumn. But obviously this was before the coronavirus became a headline issue. Translating this through to our fan chart gives the results that are shown in this chart. It suggests that the probability of a global recession, that's falling GDP per head, over the next couple of years is around 20%. The final approach that we take to estimating the probability of recession is to use a Monte Carlo simulation approach, whereby a simple model for each economy is developed in which GDP growth is a function of interest rates, exogenous fiscal policy, supply factors, etc. We then run Monte Carlo simulations on the forecast using the model's own errors as a starting point of the distribution around our baseline forecast, adjusting for views on the balance of risks if required. A key advantage of this technique and the use of fan charts is the ability to say something about the probability of recession further out in the forecast horizon. Most probit models, the first type that I showed you in practice, are limited to the next 6 months. Right now, this approach implies the probability of a global recession is again around 15% in 2020, and that the probability of very deep recession, by which we mean an absolute fall in global GDP, is probably less than 5%, although these estimates were created before the coronavirus outbreak. Let me come on now to my second topic and say a few words about how we assess the impact of shocks that could trigger economic and financial crises. At Oxford Economics, we've developed our global economic model for this purpose. It's a fully integrated global model covering 80 economies in detail and the rest of the world in 6 trading blocks. Individual country models are then fully linked through trade volumes, trade prices, competitiveness, capital flows, interest rates and exchange rates, commodity prices, and so on. And not only do we use this model ourselves, but we make it available to clients and have developed very user-friendly software so that scenarios can be readily developed and their implications presented in a range of heat maps, charts, dashboards, and so on.
Mr. Adrian, we have less than 5 minutes, so if you can jump to the conclusion, please.
Yeah, sure. We develop scenarios using these models and calibrate the severity of shocks, typically either by looking back at historic episodes or by looking at using a probabilistic approach based on historic forecast errors. For instance, what would a scenario look like that was in the 5% probability band in our forecast distribution charts? Just to give a quick example of the impact, let me show some of the work that we've been doing on the impact of the coronavirus outbreak. Now, we've been modeling these kinds of shocks since our work on SARS for the World Health Organization back in 2003. Clearly, there's a lot of uncertainty about the spread of the virus and the extent to which that will be contained, and therefore this is a classic case where it's useful to look at a variety of different scenarios. And we take into account in that modeling the impact that the epidemic may have both on consumer behavior, the availability of labor for companies, what happens to travel and tourism, financial market reactions, and so on. In all the scenarios that we've developed, the major impacts occur in the first 2 quarters of this year. And in if I just concentrate on the 2 most severe cases illustrated here, if the coronavirus epidemic is contained within Asia with relatively limited impacts elsewhere, we could be talking about world economic growth slowing to just 1.5% in the first half of this year. But if it becomes much more global in its impact, then we could be talking about a situation in which world economic growth falls to virtually zero for 2020 as a whole. So to sort of bring together my remarks, as I emphasized at the outset, there's no single technique that allows us to anticipate turning points in the economic or financial cycle. Tracking the economy and markets in real time is important, something most analysts spend the majority of their time doing. But three things are probably more important: analyzing recession indicators and assessing the signals they provide, understanding the confidence bands around forecasts, and quantifying emerging risks and their impact on the economy. New techniques like machine learning promise improvements over traditional econometric methods, but they're not a magic wand. The shock from the coronavirus certainly illustrates the challenge of predicting economic and financial cycles, but also the value of careful modeling of the implications using carefully developed global economic models. Thank you very much for your attention.
Thank you, Mr. Cooper.